Friends, last year everyone was rushing to buy gold and silver. And today, gold is down 24% and silver has crashed 47% from its peak. And if you are someone who's bought at the top and you're wondering whether to buy the dip, give me just 2 minutes. Friends, let's go back to 2025. Gold was unstoppable. By July, it was up 34% in a single year. It crossed 1 lakh per 10 gram for the first time ever that time. The central banks were buying aggressively. Jewelry demand from India and China was booming, and a record $89 billion came into gold ETFs that time. In fact, silver was even wilder. In 2024, silver took 9 months to rise 10,000 per kg. In 2025, the same jump happened within weeks. Even after October, sometime in just 3 to 4 days. Hence, daily swings of 5,000 per kg was very normal that time. And then came the big predictions. With gold was at $3,300 an ounce, JP Morgan called 6,000 by 2029 as target. And then the calls came for 7, 8 and even $12,000. And that exactly when most retail investors have jumped in. Now this January, gold peaked at $5,400 an ounce, and by late June it is at $4,000. That's a 24% fall. In India, the prices have dropped from 1,76,000 to roughly 1,40,000 per 10 gram, which is 17% smaller fall because import duties keep the gold expensive here. Then silver fell even harder, 47% in dollar and 40% in rupee terms. And here is the things, the reason has nothing to do with India. Friends, expectation of higher US interest rates, a strong dollar, central banks slowing their purchases could be the reasons. Friends, gold is not a stock whose company's results you can analyze. It actually moves on global economic scenarios and the dollar movement. Even industry veterans admit that the gold is very difficult to predict. So, what should a smart investor do at this point of time? One, don't chase rallies and don't panic in crashes. So when everyone is making price predictions, just ask yourself, what is their incentive to say that? To keep gold at just 5 to 10% of your portfolio. Simple maths, 10 out of your 100 is in gold, and if gold crash 50%, your portfolio will drop only 5%. Friends, asset allocation is your savior, not timing, not tips. 3, unless you genuinely need physical metal, use gold ETFs or mutual fund. They are liquid, you sell them at one click, no jeweler can say no. Gold and silver actually deserves a place in your portfolio, but they don't deserve the entire portfolio. And remember, your financial journey deserves the right guidance. Follow me to keep learning, growing, and saving smarter.